experience as an investor and equity research analyst at Credit Suisse, he has both market insight and financial expertise to his work. Welcome, Abhi, and thank you for joining us.
Thank you,
Thanks for having
Tatiana.
me,
Abhi,
Tatiana.
thank you again for joining us. We're delighted to have you with us today. I know you are one of the sharpest voices in the industry, and we're really looking forward to getting into the details of what's happening in the oil markets and beyond. But before I hand this back to Tatiana, a quick housekeeping announcement. Please write down your questions and comments in the chat in LinkedIn, and Tatiana and I will pass them to our guest. With that, Tatiana, back to you.
Thank you. So let's go to the point. Many people say that the age of oil is over. But the truth is that oil still shapes gas, power, renewables, even hydrogen economics. Ignore it, and you will miss the foundation of today's energy system. So I believe it's extremely important, basically for everyone in this world, to understand what's happening now with the global oil market and what should we expect in the next couple of years. My impression is, and correct me, Abhi, if I'm wrong, that the market is more or less balanced. Yeah, and OPEC Plus even started to release slowly its quotas. But this balance seems to me, at least, to be extremely fragile. And there are lots of different factors that can affect it. So let's start here. What is the current status quo? Abhi, hand over to you.
Sure, Tatiana. First, yeah, thanks again for having me. Yeah, I mean, like you said, I mean, I think just to set the table, the market is, in a pretty decent place, right? It's well balanced, but I think it's kind of got its eye on a couple of uncertainties and navigating a couple of unknowns ahead, right? Whether there's a little bit too much supply for where demand could be headed. Whether that's in part, just some seasonality or looking to next year and beyond. Whether there are any, kind of, bigger picture demand concerns to worry about, right? 3, 4, 5 months ago, we were worried about, the impacts of trade and tariffs and things like that, which have, largely been not really affected demand much at all, at least oil demand over the last several months. So is there any sort of a lingering effect? Yeah, and again, how does the market sort of digest, this ramp up of supply from OPEC plus, and also balancing, non-OPEC plus supply, and of course, trying to find the right equilibrium price range, right? We've been spending, apart from some of the Iran-related spikes, we've been spending the last several months, pretty comfortably in a limited price band in the 60s. So what does that mean for demand and supply, right? So that's what the market is trying to figure it out, and we'll certainly dig into some of those pieces here.
Excellent. So, if we are looking forward, if we are trying to solve this equation, what can we expect in the next year or two? I suggest that we start with the demand fundamentals. Yeah. And my first question would be, where is the main crude oil demand growth taking place these days? Yeah. What are the countries and the sectors to watch? Yeah, what can we expect from certain countries which are most influential, like China, like India? Yeah, and exactly. My question is, what our audience, people, many of whom are not actually deeply in the oil analytics, but what should they watch? What are the red flags?
Yeah, I mean, I think the key things to watch are, one, China has been, the biggest driver of global oil demand growth over the last, 10 plus years, right? And it's massively, expanded its oil consumption. Interestingly, on our numbers last year, China was actually not even in the top two of growers by country. It was India, then Brazil, then China. Of course, China had some question marks and a slowdown in part maybe more economic driven last year. But there are also some structural demand changes taking place in China, right? So I think the key question is how much is China slowing down, and what does the China demand outlook look like over the next year or two, but also over the next 5+ years. And I think related to that, the second big question is, okay, so if China is really slowing down, right, and and is giving up the leadership of driving global oil demand growth, then what kind of takes the baton from China, right? Is it India? Is it Latin America? Is it kind of MENA, Africa? Maybe it's bits and pieces here and there. Is it a combination of multiple different emerging countries slash regions that have to take over that mantle of growth? So I think that's another key question to watch. As I referenced, we saw that a bit last year, India, Brazil growing faster. We expect a little bit of that same dynamic this year. I can talk about the numbers, but I think that's a key demand question. And I think the third key demand question is looking out over the next couple of years is, look, I mean, I think, nobody expects anything great in terms of OECD demand growth, right? But what are we actually seeing in terms of, especially for transportation fuel, in developed markets? And I'm going to throw China into that bucket too, right? Like, is there really some kind of like a, structural peak coming for global, gasoline and maybe diesel consumption, coming over the next, several years, whether it's 1, 2, or 5 or 7, that's a horizon that we can see, right? I think that's another key demand question, whether those key segments for global oil demand are near a plateau.
But basically, just a follow-up question. Basically, you do not foresee in the, let's say, 1 or 2 years, so not midterm and not long term, but in the short term horizon, there are no surprises that we could expect, like sudden collapse of European or US demand, global recession, whatever, or sudden growth in India or in any other country. So basically, demand seems to be like flattish, yeah, growing slowly, but without any big spikes up on or down. Is that correct understanding?
I think that's a fair way to put it. Yeah, I mean, I think demand growth looks like it's going to be pretty steady. I think certainly on our numbers at least, it's slowed down, from some of the big, bounce back years that we had coming out of COVID. So it certainly looks like, demand growth will be a little bit shy of 1 million barrels a day this year, and maybe can be around 1 million barrels a day of global growth next year. So of course that's a little bit of a slowdown, from, let's leave aside the COVID period, right? Because we had a lot of like down and up and, big numbers both ways. But even before COVID, the oil demand was probably growing like somewhere between 1.2 to 1.5 million barrels a day per year. So it's definitely a little bit of a slowdown from that. And I think China is the key driver of that. Apart from that, we don't necessarily see any sort of big variances. Of course, it's always difficult to, kind of forecast, a massive global recession or something like that. But even a couple of months ago, we said, look, like, yeah, I mean, there were uncertainties around trade and tariff and things like that. But especially after OPEC Plus started adding supply, we said, look, like, with prices moving to the 60s, and remember they even went to the 50s back in April, we said this was going to be pretty supportive of demand, right? And we've seen demand, hold up pretty steady over the summer months, and of course there's some seasonal help there. But yeah, I mean, I think in a market where there's kind of enough supply, you could say ample supply. We'll talk about the supply side a bit. We think demand will hold up pretty steady, and can even disconnect a little bit from some of the economic uncertainties that are out there, right? So again, like we think Western oil demand in the US and Europe, the visibility is pretty good. Like it's not growing really, but it's not going to be falling off a cliff either. And then the question becomes like, China, India, emerging markets, what happens to demand in those places, and in lower oil prices and weaker dollar, those sort of factors, help those markets.
So nice segue, and I want to stick to the demand theme here, keeping to the fundamentals around it. So let's say Brent averages around $70 in 2025. At $70 Brent, the headline prices almost looks manageable. But when you look at markets like India, Indonesia, and Pakistan, the demand is shaped by as much as the currency depreciation and subsidy policies as by flat oil prices. So, how much demand do you think or do you expect in these economies? And are we really underestimating the fiscal strain on governments that are trying to shield consumers here?
It's a good question. I mean, I think the fiscal strain question is a really important one because I think it's a global question, right? I think there's governments attempting to shield consumers and protect economies happening all over the world. I think you've seen that for many years, even going kind of coming back out of COVID in the U.S. and in Europe. Certainly in emerging markets in China, right, which has had multiple economic hiccups and question marks and debt questions pop up over the last couple of years. I mean, I think this is I would actually, to quickly get to your question, I mean, I think this is probably, the big, kind of global economic question slash risk that's out there, right? Whether just governments are just overstretched, overburdened, and trying to do too much, right, to either protect or jumpstart or drive their respective economies. And I think, I mean, look, like in the U.S., for example, especially, now that, interest rates are higher, they're higher all over the world, even though, the Fed is trying to cut and whatnot. The cost of, servicing that debt, just, the interest expense has now become such a massive a burden for many governments. So I think managing that, being able to continue to spend on various other things, whether it's defense or healthcare or what have you, or other public services. If governments can kind of continue to do that and manage huge debt loads, I think is the big kind of global economic question. For now, again, back to emerging markets. To your question, I think governments have been able to manage. I think these economies are managing to grow. I think there are questions, there are concerns, there are some headwinds for sure. But these economies also have tailwinds, right? They have tailwinds from I think inflation having eased. Energy inflation having eased, and of course, commodities is a general term, but at least in certain commodities, whether it's food or other areas, seeing a little bit of an easing of the burden that we saw, creep up over the last couple of years. So I think generally, emerging economies are being helped in maybe enough ways to continue to drive growth. Plus there are other factors. I referenced the weaker dollar, for example. The dollar has, year to date had one of the weakest performances of all time. Now, from an emerging market perspective, that helps from like a trade standpoint, from an import standpoint. It helps from a capital flow standpoint. It helps in terms of borrowing costs and again managing some of that debt, right? Because their currencies are not depreciating. The opposite is happening relative to the dollar. And so the emerging markets do get a little bit of a benefit from what's going on, at least with the U.S. economy. So I think I think emerging markets are holding pretty steady right now, right? And I've also tried to sort of stay away, and we can talk about this later, stay away from from some of the conflicts and the geopolitical hotspots and being impacted by those, right? I see a couple of questions popping up around Russia flows and things like that. So I think especially those big economies like China, like India, and other kind of let's call it Asian slash Middle Eastern slash African economies they've been trying to sort of steer clear of getting involved in some of these conflicts, and so that also helps them just kind of focus on their domestic economic agendas.
Great. I think, I've noticed that question as well. So do you want to answer this question around where is Russian oil flowing and how it's being transported? And I think there's also a follow-up on will EU or US sanctions affect Russian export Any thoughts on that till now?
Maybe we can come back to this one because I think
Okay.
we'll flip to supply very soon. So Tatiana,
Yeah.
you weave those questions into the next section if you want to wrap
Right.
up.
Just want to make sure that we're filling those questions as well. So thank you for those questions. Please keep them coming and post them in the chat. We will be taking those questions. But let's continue just a little bit longer on this demand theme. Um, so let's think about diesel demand, for example. Diesel demand is flattening in many OECD economies. Jet fuel continues to recover post-COVID. The petrochemical growth remains, as the vital engine there, especially in Asia. Which of these do you see as the true barometer for demand strength in 2025, 26? And more importantly, what does that mean for refiners and exporters?
Yeah, I mean, look, in our view, you're going to see growth, pretty much across all these products in 2025 and 2026. But definitely you're going to see a slowdown, as I referenced earlier on the transportation fuel side, right? So, and I think gasoline is the first one to watch, because, I think again, the shift away, the substitution away from gasoline is something that you're seeing in many big economies, from the US to Europe to China. And I think that's going to be the first one to sort of slow down in terms of growth, firstly, and then actually hit that plateau level. We think sometime over the next couple of years, and by couple, I'll say kind of 2 to 4 years as the window for gasoline. Now diesel is a little bit different because when I look at diesel, I look at diesel as kind of a real barometer for kind of the global economy, just because for the most part, it goes into trucking, to freight, to industrial, machinery, agricultural equipment, those kind of markets, which are, like kind of your meat and potatoes of your economies worldwide, right? So, and of course, diesel, there's still, diesel cars used in Europe and other places as well. So diesel, I kind of look at as kind of like that real gauge of the global economy, and diesel is holding up, pretty okay this year. And I mean, it's not doing great in terms of growth, but it's holding up pretty okay. And so that's why we think, like the global economy has kind of been able to manage through all these uncertainties and unknowns over the course of this year. In fact, we think, diesel will actually, probably pick up a little bit on growth next year. We think, global demand growth next year will be stronger than this year by 100 to 200,000 barrels a day, because of a little bit of that recovery, and some of that is diesel related. The one thing I would say about diesel is, we do think diesel demand will kind of be a little bit stickier and more resilient than gasoline demand. Again, because of that freight, trucking, industrial component, right? Again, it's especially for emerging economies, as they grow, as they expand, as they build out networks and manufacturing and industrial footprints, diesel demand becomes, very important. And there's really no other way to do it apart from burning more diesel. I think probably the only exception is China, which has started to substitute away from diesel for their trucking industry pretty dramatically. And that's a combination of electric, but more so, LNG gas trucking. So I think, China is the one again, where we could see that diesel market, getting pretty close to hitting a peak in the next couple of years. But everything should grow. And I think, to your point, back to some of the other segments, again, I think, look, we think jet fuel, petchems, those segments are going to grow for a pretty long time. It's really just hard to find any kind of a meaningful substitution away from those, whether it's sustainable aviation fuel or recycling or alternatives to plastics or what have you. We think
Mm.
those markets are going to grow for like the next 10 to 15 years pretty comfortably, if not beyond that. So yeah, so I mean, I think the last point is it is kind of incumbent on refiners to sort of parse all these moving parts. I think definitely for starters they're trying to figure out how to move a little bit at the margin away from gasoline to diesel, because of what I talked about, but also manage the fact that that jet fuel will remain strong. Having kind of an integrated complex with petchems is advantageous, right? Because you can see a lot more visibility to growth in those markets, especially emerging markets, as those economies grow and middle classes build out. Plastics demand is going to grow. And even with EVs and stuff, they all have like pretty heavy plastic content, right? Just to keep them lightweight and whatnot. So yeah, so I think those segments will see growth for a pretty long time. So in the next couple of years, we'll see. I think the last one I'll say on demand is between 2030 and 2040, what we're going to sort of see the market try to balance is growth for some of those growth sectors, offset by maybe that plateauing to a gradual decline for gasoline, and maybe diesel.
Right.
Excellent.
And what do you think about the exporters? The center of gravity on the oil demand is shifting eastward. So I assume the exporters will have the increasing need to reorient their trade flows as well. Any thoughts around, you mentioned the refiners, any thoughts around the exporters there?
Yeah, for sure. And I think, let's just take the case of like, OPEC/OPEC plus countries. Yeah, all, sort of looking to, kind of help facilitate or partner in demand centers in India, China, Southeast Asia, in part Africa, right? Because that's where the incremental demand comes from. And Africa is adding 1 billion people, and Southeast Asia and South Asia are still growing populations. Now China is different, and of course OECD generally is different, demographically. But yeah, you can kind of see where the growth, where the consumption expansion is going to come from. And that's certainly from an exporter standpoint, that's where they're pivoting and reorienting their thinking.
Cool. Now I want to take the lead and to turn to supply side. I'm already like jumping to ask you my question. So let's take a look, first of all, at the US shale performance. Yeah, there are many people, and our previous guest, Morton Frisch, for example, was mentioning that the US has passed its most productive phase. Yeah, so there can be some upside, but it requires much higher prices. Yeah, and it won't last for long. So true or false, what do you think about shale oil? But also, if not for it, then where are the potential incremental new barrels coming from? Yeah, next year, 2026, maybe 2027. So is it Guyana, Canada, Brazil offshore, whatever? And what price do they require to actually happen to come to the market?
Yeah, great question. Because of course, U.S. shale is always like one of the big, swing factors, right, for global oil market balances. I would just say, look, like, today, WTI is, around 65. This is really just not a price that drives much, if any, growth at all, for U.S. oil. And I'm leaving aside, kind of NGLs and other liquids for a second. But just for pure oil, it's really kind of more of like a maintenance price. I think you could probably see some marginal growth. Especially because of of big companies like Exxon, Chevron, and a few other big shale players. But generally speaking, it's an environment that is much more of like a maintained production type of price backdrop. Our base case actually is that U.S. oil supply is going to slightly decline, going into next year or looking at next year, but not by much. I think it'll be able to largely maintain these levels, assuming prices can kind of hold in the 60s. But again, I mean, I think just to put some sensitivities around it, like you set up, if you want, real growth from U.S. shale, you need comfortably in the 70s. And the market is just not signaling that, right? We'll talk about OPEC plus, but OPEC plus adding, kind of enough barrels back to keep the market supplied for now. There's just not any need for any incremental U.S. oil for now. And yeah, I mean, you really need to have, kind of sustain, not just hitting 70, right? We need to have the prices, sustaining 70s for companies to continue to grow. And the flip side is, yeah, I mean, if for whatever reason you have like downside to oil prices, right? Let's say WTI goes to 60 or 55, I think that will mean you'll have a little bit more of a decline next year for U.S. oil supply. Now, U.S. oil supply is a little bit different because it's not just about oil prices, right? Because for many producers, they produce three streams, right? They produce oil, gas, and NGLs. So it's really about all those prices, all the economics put together, and the demand for each one of those products. Now, NGL demand is pretty strong. Gas demand is pretty strong for U.S. producers, both domestically, and of course, there's a lot of visibility to LNG growth over the next several years. And so I think it's going to be hard to see U.S. oil supply fall off too much, because they continue to, producers are continue to, drill because the gas has growth, the NGLs have growth. And so even if oil is not that great, generally, as long as oil is in the 60s, like it kind of makes sense. But yeah, I mean, I think, look, like, shale is, the cost curve for shale is moving up. And so, if shale is going to be a growth sector for 5+ years ahead, you really need, $70+ oil sustained. And it's hard to see that. So, I think it's really, going to be a little bit more of like a maintenance level for U.S. shale oil.
And what about the others? So I understand OPEC plus, it's a very big piece. We'll talk about it later, but the other non-OPEC producers, do you expect any significant upside from their side?
Yeah, look, like, there's definitely upside in Latin America, right? Guyana, Brazil. I think there's, a decent amount of visibility, and the question really is just like the pace of the ramp up, right? Like how much do they add year after year? But they're both going to grow for the next 5 years. You're going to get some incremental growth out of Canada as well, and that's part of the challenge for U.S. oil supply, right? Even just within the Americas, there's growth. And it's not massive growth, but it's enough growth that if you add it all together, plus you add US NGLs, right? You're already at, 6, 7, 800,000 barrels a day of supply growth. And then if you add OPEC on top of that, then there's really no room for US oil to grow, at least over the next couple of
Yeah,
years.
and just one MBD of potential demand growth. Yeah,
Yeah, exactly.
so
And even if it's, even if there's demand upside, right? Even if it instead of one, let's say it's 1.2 or 1.3, something like that, like for example, like that's what OPEC forecasts, right? OPEC forecasts about 1.3 million barrels a day of demand growth this year, next year. Let's say that's true. Even in that case, the combination of non-US, non-OPEC plus and OPEC plus seems to be enough to meet that at least over the next couple of years.
Right. So let's look at the NOCs for a second. And so with the push for diversification will drive capital into some of these newer technologies, especially around renewables and hydrogen, or will they double down on oil as a last growth frontier? So NOCs control the majority of the reserves and production, but their logic is political as much as it is commercial. Do you see them using current cash flows to diversify into renewables and hydrogen, or just simply doubling down?
I would say yes to the diversification, and I would add to that also gas LNG. Some may say that's you could call that clean energy. Some may say you don't. I don't think anybody calls gas LNG renewables, but some do look at that as a cleaner part of their portfolio. So I think the answer is yes. I think definitely the focus is more by and large more on that diversification away from oil. But I think there's still there's still a focus on on the oil side as well, on maintaining capacity for a few NOCs, right, for a few countries,
Mm.
expanding that oil capacity. But that's really like maybe like maybe 3 to 5 countries at most, within OPEC plus. Uh, but yeah, but I think I don't think the focus on oil is gone yet. I think there's still because just to put some numbers around it, right? I mean, we think OPEC plus spare capacity right now is around 4 million barrels a day, right? Like true usable spare capacity. Now, OPEC plus will always want to keep, let's say, 1.5 to 2 million barrels a day of capacity in reserve, right? Just in case there's some conflict or supply disruption or some problem, they want to keep some spare capacity. So they have about, let's just say, 2 million barrels a day of supply to add, maybe a little bit more.
Mm.
But again, if demand keeps growing and there's not enough non-OPEC plus supply, they'll use up a lot of that capacity as they bring it back to the market over the next couple of years. Then you'll be much tighter on spare capacity. So I think there will, to your question, I think there is still a focus to maybe continue to add a little bit more capacity over the coming years, especially if that demand visibility remains pretty good. And again, this is in the handfuls of the ADNOCs and the Saudis, but and maybe a little bit in like Iraq and whatnot. But again, it's a pretty small list on the
And
So
oil
I
side.
do think it's a binary choice. It's not either or, but rather both and. I
And
would imagine,
NOC specific too. Yeah, NOC specific.
yeah. So the fiscal imperative for most NOCs, and at least their primary mandate, is to generate revenue for the state. But then when you look at the low cost producers, unlike the IOCs, which are under pressure from investors and policies on various fronts, um, I feel like there's almost like it sounds like a dual strategy for considerable time.
Yep, I think that's fair.
Okay.
one finger on IOCs. Yeah, Abhi. Yeah, so we've talked about NOCs. What about oil majors, like the big old
Right.
guys?
Yep.
Uh, um, some of them started already to announce headcount cuts. Yeah, they do not seem to be absolutely happy. So, what do you think will be their strategy in this potentially slightly oversupplied market? Yeah, let's put it this way.
I think I would just say put it like maybe simply as lower their break-even price, right? Which is a in this environment, which is to your point, a big driver of some of the cost cutting and kind of corporate slimming that you're seeing across many of these companies. This is the IOCs, and also I'll add maybe like the big independents into that.
Mhm.
Into that group as well. So, trying to lower that break-even price, right? And then I think it's just kind of wait and see, right? Wait and see on the next, year or so to see how the market sort of bounces out. Like, do we really have too much supply? Do we, how does OPEC plus, continue to add supply back to the market? And most importantly, how does demand shape up, right? Because I think back to what we were first talking about, I think a big question is there kind of a structural slowdown of demand growth ahead? Or is there not? Or we're going to grow 1 million barrels a day per year for the next, 5 years plus. And if that's what it looks like, we're headed, then these IOCs can start to maybe put money back into the drill bit, get the capex going again to get supply going again. But I think they need to see both the demand and the price signal for that first. So that's why I think it's a little bit of a wait and see.
I've got here two questions from our audience regarding the US shale. The first one is from Vedat Chergui. Do you think US shale oil will reach $80 in the near future?
Yeah, I mean, I think maybe the question is maybe will U.S. shale oil see $80 or maybe the cost of it becoming $80. So maybe I can answer it both ways. But yeah, I think it's hard to see $80 as kind of a sustainable price over the near term. And I think because OPEC Plus is still in a supply addition mode, right? It like, I don't, I think at least over the next like sort of year or so, it's hard to see, there's still enough supply. Whether demand growth is zero point 0.8 or 1 or 1.2 or 1.4 million barrels a day, there's enough supply to meet that. So it's hard to see that, that the price getting there. And then answering the question another way, whether U.S. shale oil, maybe the marginal cost is $80 or gets there soon. I don't think it's soon, but yeah, I mean, look, as the cost of drilling gets more expensive and and your resources get exhausted and you're using up your best and best acreage. I do think U.S. shale oil will, at least the marginal cost will at some point approach 75 to 80. But I don't think it's in the near future. I think, that may be more like 5 to 10 years out.
Okay, and then another question from Jin Sok Sung. You've mentioned this triple composition of the US hydrocarbon production, and so he's asking what's the share of associated gas in the US? I think it was oil production, yeah, or general production, and how significant is the impact of the US oil production dynamics on the US gas production volume in the short and medium term?
Yeah, no, great question. Yeah, because I think this is an important piece of it. Look, associated gas production, coming from oil is, roughly like let's call it around 40% of total gas production, right? So it's a pretty big chunk. And so of course, oil prices are pretty important for that, for that chunk, as are NGL prices too, of course, because it's three stream. But yeah, I mean, I think. I would just say, I would just kind of reiterate what I was saying earlier. I think as long as oil prices, kind of at least hang in the 60s, and you have, decent gas prices, at least for US gas north of $3 plus, on Henry Hub, and decent NGL prices, I think the associated gas production piece will continue to hold up, and grow slightly over the short to medium term. Again, because a lot of these, more and more of these companies are, kind of tying into, the gas stream, whether it's domestic demand or, tying into LNG projects, and developers. And so, that becomes an important part of the revenue stream and the financials. And also because the visibility on the growth there is good, that helps the associated gas piece hold up relatively steady. The only other thing I would say is, I mean, look, looking back to the previous question, I mean, from a global cost curve standpoint, US shale is still pretty attractive, right? And so, yes, it's capital intensive, but it's also still, pretty attractive. And so it still makes sense for, in a, $65 world for WTI and close to $70 world for Brent, for U.S. oil to continue to be produced, even without a lot of growth.
Mm-hmm. Look, most of the questions that we are receiving are actually related not to the supply side, not to the demand side, but rather to geopolitics.
Politics,
Yeah.
exactly.
And so oil market is not driven by only by fundamentals. There are lots of other risks like physical risks, geopolitical and political risks, and sometimes we were discussing it previously with Kritika, policy-driven shocks. They seem to be more important than even physical disruptions with the sanctions enforcement, or with shadow fleet insurance, or with strategic petroleum reserves built up in China, for example. They may matter more. So in this all variety of different additional non-fundamental factors affecting oil market, what are the most important in your view?
Oh, great question. Yeah, we could spend a couple of hours just talking about geopolitics, but it's a critical part of of kind of oil market dynamics and price formation. even if I would say the geopolitical actual, risk embedded in the oil price today is zero, it's still important to watch, right? Because it's still, impacting the price in some shape or form. I would say, look, I mean, I think the key things I would highlight are one, the relationship between Washington and the Middle East, I think is an important one. I think it's impacted prices already this year and will continue to be a driver. You have an important visit from the Crown Prince in Saudi Arabia visiting Washington coming up pretty soon. Of course, and Trump's of all the things that Trump is focused on, I think his main priority is low inflation, and trying to get the Fed to lower rates more than the slow lowering that we've seen so far. That's his main priority, right? Especially next year is a midterm year in the U.S. So it's going to be a big priority. So I think that's the key one to watch. Of course, I think now, at least like from a conflict standpoint with the Middle East, maybe not, posing as much, at least physical risk, right, to oil, energy, prices, markets, infrastructure, for now. I think the Russia dynamic is key to watch. Again, so oil market is very resilient. I think India and China have, by and large, despite sanctions and proclamations from Washington and Brussels and other places about what they want to do or don't want to do, by and large, India, China can, trade with Russia pretty much as they want, as they wish. And I just don't see that changing anytime soon. I mean, even if there's some big like announcement or some big message or a big tweet or what have you, apart from like a few days of trying to, parse through it, nothing really changes, and I don't think that's going to change. And so, trying to figure out again, I mean, I think one of, at least Washington's biggest challenges will be trying to figure out, how to get some kind of a resolution to the Ukraine conflict, right? Because it's been very slippery, dealing with Russia, as far as Trump's concerned, and even he's gotten, quite frustrated about it. But in terms of oil market, I just don't think it matters. I don't think it's really going to impact things. And even from like a Europe perspective, because I saw that question pop up as well. I think again, Europe will try to, kind of, message shifts away from Russian energy. But, again, the market always has these, sort of bypasses and loopholes and shortcut mechanisms or, third party ways to reroute things, whether it's oil or products or what have you. And so, look, like, at the end of the day, whether it's an emerging market consumer or a European and US consumer, they need the products they need, and there's only so much supply going around, and we think the market will kind of figure out a way to reroute it. And so again, I just don't think there's going to be that much of a geopolitical disruption factor to oil prices anytime in the near future. And then the last thing I would point out is just maybe just this kind of multipolarization, let's call it, of the world, right? And kind of the global South or the developing world, or kind of like the BRICS plus blocks, just kind of coordinating more and moving ahead, and how that impacts the market. It could very well be, kind of a general net positive for oil demand growth. And producers, suppliers, exporters, may need to watch that and follow suit. Because again, the priority for this block, whichever way you want to call the block, is economic growth, expansion, and development. That is the main priority. So I think that's another, kind of key geopolitical factor to watch.
Excellent. So before we move to the deeper discussion on OPEC Plus, and I see there are also questions on that, but as you've started already talking about Russia, I just want to make sure that we respond the questions that we've got. So there was a question from Bora Fostel. about like where is Russian oil flowing and how it is being transported. So I think the answer is pretty simple. It's flowing to China and India, a little bit of Turkey, a little bit of the Gulf, and growing unknown destination, whatever it means. So the volumes going to Europe via Druzhba are really more of symbolic, yeah, though there is a lot of discussion right now between Trump and European Commission on this matter. But basically there are two countries, Hungary and Slovakia, receiving this oil. Yeah, and it's more the matter of principle. And the seaborne crude is moving like both with the regular fleet and with the shadow fleet, which is growing and growing and growing. And I think the latest development, and I would be keen to know what are you thinking about it, that China is, and it seems that India during the last month are more of like allocating specific ports for this sanctioned Russian crude transported with the shadow fleet, yeah, so that it is like excluded from the rest of the transactions. And even if it gets sanctioned, okay, let's keep it sanctioned and let's keep receiving Russian oil here. So it's like a parallel market evolving. Yeah. Abhi, what is your take on this? And more importantly, this question: will EU or US sanctions affect Russian exports? Will Ursula von der Leyen, who said yesterday that EU will put additional tariffs on Russian oil, could that impact? Somehow affect global oil trade. Yeah, so just to reinstate that, like, relax, guys.
I mean, Tatiana, you put it really well. You know the space well, and you're an expert on this. And I think the short answer is no in terms of affecting it. And yeah, I mean, sure, there could be some marginal, impacts here or there, but just basically just kind of redirection of some smaller volumes from one place to the other if needed. But by and large, I don't expect much of an impact. So.
Thanks.
Right. I really like this segment of this conversation. Oil is, it may be declining in numbers, but I think it still remains the fastest and the most global transmitter of geopolitics somehow. I wanted to focus a little bit on the OPEC, and we've got a couple of questions around OPEC Plus as well. So OPEC Plus discipline has relied heavily on Saudi Arabia. How long that burden can be carried before Riyadh shifts from defending price to defending market share? The Saudi has cut disproportionately to stabilize the market, but at the cost of lost volumes as well. So how sustainable is this model, and at what point does Riyadh prioritize long-term market share over the short-term price stability? Any thoughts on that one?
Yeah, I mean, I would actually generalize that question to OPEC Plus more broadly. And I think you've already started to see a strategy that looks at share, over the last 6 months already, even if that means sacrificing price to some degree. I think the group, yes, oil prices in the 60s. It certainly impacts revenues and budgets and stuff across the OPEC Plus group. But I think that we're still close to 70 for Brent, and it's still at a range that I think is manageable slash tolerable, especially as they aim to kind of claw some of that lost share back from the last couple of years. And I think I think the group will be kind of looking at this over the next couple of years. Watching demand, as long as demand can continue to grow. Again, prices in the 60s, it does have an impact on US shale. It does have an impact on other non-OPEC plus sources of supply. Maybe those are more marginal because those are longer lead life projects, but it does have an impact. And so as long as demand continues to grow, let's call it 1 million barrels a day per year for a bit, the group will be able to get share back, between 2025 and 2030. And so that is already kind of taking shape. Yeah, and I think it's sort of this balance of watching prices, but also watching demand. And if the demand signals are robust enough, then it's fine. One thing we didn't actually talk about, Tatiana, you referenced it earlier in your question on geopolitics, is around storage, right? And SPR usage, and China has been a pretty supportive buffer of the market this year. Adding kind of excess barrels. China, as is any big consumer or net importer of oil, is quite price sensitive, and with prices below 70, it's an opportunistic time to fill up the tanks. So they've been doing it. There's still a lot left to fill up, by the way. This is not.
What
uh,
is the size of their
I mean,
SPR?
we still think
Nobody
that we
knows, but like,
yeah, exactly. It's a little bit of a black box, but we still think there's like, 20 to 30% capacity still left. Again, like between the SPR and the commercial, you can kind of combine them as as one and the same, right? Because effectively even commercial stock can be used for national interest in China. There's still like, 20+% capacity. So the capacity is there. We're not like anywhere close to tank tops or anything like that. And so, we think that, even if prices hang in the 60s for longer or drop into the 50s, in 3 months, 6 months, or, early next year, that China can still soak up excess supply, and likely will do so. And that's why we think prices can hang in the 60s, even if there is a bit of an oversupply in the market. We think there's room to put that, right? I think the downside risk to oil prices really crashing are, when there's just nowhere for the oil to go. But we think that SPR usage is still an option to help, kind of buffer the market. And so I think that's another, anyway, back to the OPEC Plus question. That's another thing that they're watching pretty closely. Demand, storage, and prices, and that combination of those, and how to kind of inject supply into that. But one point I'd make, just kind of looking back over the last 6 months, OPEC Plus has announced, 2.5 million barrels a day of supply increases, give or take, depending on how you do the math, over the last 6 months. But they've only delivered about two-thirds of that in terms of actual supply ramp. So that's another thing to watch. Looking ahead is, what does that gap look like? And also, again, how much do they put out to the market in terms of exports versus, kind of withhold it, and then maybe produce and just store it domestically too. That's another piece of it to think about. So yeah, so we think OPEC Plus is generally okay with the market as it is. Definitely the market isn't as strong, just fundamentally, in the winter months. So that'll be one thing to manage, and then, kind of getting through to the next, big, seasonal increase in demand in the spring, will be what the group will be watching.
I have short follow-up questions. So the fact that OPEC Plus is not actually delivering the announced volumes, what do you think is behind it? They are unwilling, or they simply can't deliver?
Yeah, I don't think it's unwilling. Yeah, I think it's more just the ability to do so. Again, the ability to kind of like just comfortably ramp up really just sits with a handful of the members, right, within OPEC Plus. So I think the ability to kind of just easily ramp up is not so easy for the group broadly. There's also been some other factors, right? Because there is obviously in the summer months, there's a big, ramp up of domestic demand, just for power burn, domestically. And so that impacts the export market less, because they just push less supply out. But as that, demand, kind of wanes, which it should start doing pretty soon here, then how does OPEC Plus manage that, right? Will be another key thing to watch through the winter.
And a question from Ruben in Japan. How efficient is OPEC Plus discipline these days, and how important is OPEC Plus as a determinant of crude oil price formation?
I mean, the second part of that question is easy. I mean, I think they're probably You could argue whether they're the most important driver of crude oil price formation or the second most after, what's going on with demand and macro and whatnot. But they're either one or two. And again, but I think it's a little bit more nuanced because of you have to think about how much supply they're actually adding versus, what's necessarily announced. But I think from a discipline standpoint, I think from a cohesiveness standpoint, I think the group still has it together pretty tightly. And again, like, sometimes you hear of, some grumblings and issues when prices drop, right? But so far you haven't really heard much. It's been, pretty smooth sailing for OPEC Plus over the course of this year, even though, you know, the 90s, the 80s, the 70s prices from the last couple of years have now dropped to the 60s. The discipline still seems to be pretty good. And again, supply additions are pretty comfortably lagging, right? The headline announcements. So we don't have an issue in terms of, any broad-based compliance or, lack of compliance within the group.
Excellent. Tatiana, do you want to see if there are any other questions? I have one more question for Abby from my side, but we'll give preference for audience questions. Is there
No,
anything else?
I don't see any other at the moment, so
Okay.
I think we have to ramp up already. So your final question.
Yeah, so I have one final question. So, Abby, oil's share of global energy demand has slipped below 30% and yet the volatility and the geopolitical leverage continues to remain high. Are we entering a paradox where a smaller oil market actually amplifies the fragility? Because fewer barrels seem to carry the disproportionate weight in setting prices and transmitting shocks. Or do you think it's really on the opposite, becoming more resilient in case of, say, for example, the case of oil prices during Israel-Iran war this summer?
Yeah, good question. I mean, I would say, to your point, yes, maybe oil share of global energy demand has been slipping because of the ramp up of, renewables, but also gas, right, which is growing faster than oil now. But it's like, but that share hasn't changed all that much. I mean, it's still, oil. I don't have the numbers on top of my head, but oil, just kind of traditional hydrocarbons in general are still, kind of like the comfortable majority of global energy demand / consumption. I think it's somewhere between 70 and 80%. So it's still like such a big chunk. And so, yeah, I mean, I think that's why it still has the ability to, I would say oil has the ability to impact, at least for now and for the near future, impact at least the global energy system more than gas, more than any other market, still, whether it's geopolitics driven or something else. Yeah, I mean, oil, is still, even if it, kind of is moving to like a slow growth or no growth phase, is still like such a dominant energy source that's not going to change anytime soon. And because the price of oil impacts fuels and, and jet fuel and petrochemicals and then, downstream so many other things and products, it's still such an important part of the consumption wallet, that it still matters, both, in the developed world and in emerging markets.
No, that's very well put, Abby.
Very, very, very last question from
Sure.
your
Great.
China is growing renewable energy because they dominate wind, solar, and battery production. US not. Fossil is king. So who will win? Electrostates versus petrostates, our favorite topic.
Yeah, I mean, I think we can talk for an next hour about what defines winning, but but yeah, I mean, look, like, yeah, I mean, I think, each country, each region, has its own strengths and its own kind of advantages, right? And that'll probably be what dictates winning. I mean, look, like, the U.S. is still a fossil fuel powerhouse for now, right? So in the near term, that matters more than what happens with renewables. China has spent 10 to 20 years building up a renewable energy powerhouse, and because they don't have that much domestic oil and gas production, and rely a lot on imports. That's important for them. So, that's a strategic advantage for them that probably has, medium to longer term ramifications and winnings. But yeah, so I think that's a super interesting question that could, be the topic of a whole nother conversation. But yeah, look, like, in the near future, again, it's traditional energy that kind of dictates, the impact on the economy, but medium to longer term, that share will continue to shift, at what pace, will be the question.
Brilliant. Well, thank you, Abhi, for that enlightening conversation. I think you clearly highlighted how it's a center still is the leverage for a number of different things, including a financial amplifier, a geopolitical trigger, and the sort of anchor for prices as well. So today's discussion, you really helped us show that oil still matters. We may love it or hate it, depending on our relationship with the industry. I think Tatiana and I, for one, we're very, very much in the center. We like to see and have this discussion, which are not too anodyne, but really to challenge our own assumptions about the various things. And thank you for being so generous with your time with us and for answering all of those wonderful questions and really smart, insightful questions from our audience as well. So oil is no longer the whole story, but it's a chapter that none of us can afford to skip. I want to thank you again, Abhi, personally for myself and on behalf of Tatiana and all of us at New Energy Advancement Hub. Thank you for joining us and sharing your insights. I hope this has been useful to everyone who's listening, and thank you for your contributions to this discussion through the chat. And to you, Tatiana.
Yeah, Abhi, just a grand thank you. That was cool. Really, this hour flew like a moment. Yeah, and I really like the way how you framed it all, structured it all. So I hope our audience has now much better understanding of this very complex topic. So thank you, Abhi, and you guys. We'll see you at the next Power and Purpose Live. Until then, stay curious, stay pragmatic, and stay focused on what really drives energy markets. Thank you and goodbye.